Well, retail investors on the Singapore Exchange could soon buy into more high-growth, high-risk stocks, as schemes are being rolled out to attract more fast-growing firms to list in the country and improve liquidity in the market. It includes a $1.5 billion fund by the government and state investor Temasek. Brendan Tanner with more.
3, 2, 1.
More high-growth firms could soon find their spot on the Singapore Exchange more easily, with capital from the new Anchor Fund at 65. Those 2 or more funding rounds away from a listing can also tap on another $500 million fund by the Economic Development Board's investment arm. The fund will help them grow their operations in the country.
The central bank's involved in the effort as well. It has enhanced a grant scheme that defrays listing costs, doubling its cap to $2 million. Now, the grant also supports listings of special purpose acquisition companies, which are shell companies that raise cash and buy over a firm to take it public.
The Singapore Exchange will also support high-growth firms with solutions such as access to private fundraising and global investors.
We know that the initiatives we are launching today are no magic bullet, but we believe that they will blow new wind into the sails of our public equity market and make SGX not just a viable, but a compelling option for innovative growth companies seeking a public listing. Ultimately, we are not doing this just for the sake of having high valuations or market caps.
It could mean more choices for investors to sink their money into, and observers say the measures could also be a boon to Singapore's economy.
We could have a situation where more banks are hiring people to get involved in these transactions. Investment banking could have a boom because of these measures. There could be a whole ecosystem around these deals, which would benefit Singapore's financial services industry.
Analysts add that these high-growth firms are set to come from the tech, healthcare and even electric vehicle sectors. Meanwhile, SGX has also been boosting its appeal to such firms in other ways. For instance, it's replaced mandatory quarterly reports with a new risk-based reporting regime last year.